Now, just what does all that competitive talk about growth mean for investors looking at supermarkets? And if growth for the duopoly continues, how much more market share could they achieve? Perhaps in different markets. Well, joining me now is value investor and fund manager Roger Montgomery. Roger, welcome.
Thank you, Ticky.
And happy Easter.
Thank you, and to you.
Now, how do you see these two giants in value terms?
Well,
you've been crunching some numbers.
Watching that report, we have been, and watching that report, you can see in the numbers I'm about to present that there's actually been a massive land grab going on. It's growth almost for growth's sake, so that the other competitor doesn't get that slice of the pie. So if we have a look at Woolies, for example, their profit has grown since 2004, so over the last decade, grown from about $700 million to $2.4 billion. That's pretty impressive, but it's less impressive when you consider that the amount of equity that's been invested by shareholders in order to achieve that growth. So you've got a four-fold increase in profit, you've got a seven-fold increase in the contribution of additional capital from shareholders. On top of that, there's been almost a six-fold increase in retained profits. And when you look at the debt as well, debt has gone up by almost 10 times. So debt's gone from 500 million to about 5.9 billion forecast for 2014. So if you put more money in a bank account, you earn more interest. If you give a company more money, its profits should go up.
Yeah, so you're saying in value...
And they have been going up. But what's interesting is that the return on incremental equity that Woolies is getting so far is less than what it was getting on its original business. Yeah. So its return on incremental equity is now about 15%, where its return on equity of the whole business is about roughly 25%. So as they grow, they're becoming less profitable. Still extremely profitable.
Yes, the absolute profits are going up and up.
Yeah, and considering their size, but less profitable. It's a bank account with $10 billion in it earning 20% is worth more than a bank account with $10 billion in it earning 15%. It's as simple as that. Now, Woolies is still cheap relative to its intrinsic value. So over the last 10 years, its intrinsic value has gone from about $6.21 to about $35. Over the last decade, and its price at the moment is about $37. So it's about fair value. And if you consider this, how safe the growth is, that seems like fair value. It seems like a reasonable price. We heard in the last article, the last story there, that the market does often think it's the slow lumbering giant, and so prices it accordingly. They've priced Wesfarmers far more optimistically. Its price is at double
why do you think
its value is. Well, I think if you look at the number of stores, it's got 700 odd less stores in Australia, so the market would believe it's got more growth potential. And the market typically pays for growing earnings rather than profitability. Now, after Wesfarmers bought Coles, their return on equity absolutely plunged, and as a result, their intrinsic value went from about $27 before they owned Coles to about $11 after they bought Coles. Now, it's since doubled to about $22, which makes their value about $30 billion, about their equity, but the market's putting them on $55 billion of market cap.
Now, in the meanwhile, we've got somebody like Brian Walker in that piece saying it won't just be supermarket growth, it'll be growth in liquor, in petrol, potentially pharmacy. What is the ACCC going to be doing about all this?
Well, it's important, and I'm sure the ACCC know this, but it's important that they don't use a microscope and just focus on what's happening now. What they need to do is they need to use a telescope and think about what the impact of the strategies they're employing today is going to be on business and suppliers in Australia in the future. It's great that we've got such strong, viable Australian businesses, but not when it's the expense of Australian suppliers, because if they go out of business, we're relying more on overseas imports.
But kind of what you're saying is that, in a way, yes, that suppliers will get shortchanged. In the longer term,
well, consumers and suppliers miss out.
Consumers and suppliers, but even shareholders in the longer term, if your returns aren't...
Because as you lower your prices, you're lowering the revenue. Now, I believe, and this is the concern, I believe that once you put your competition out of business, then you can raise your prices for generic products.
Well, this was the concern. I know in Britain years ago that this would happen.
And unless that's controlled and looked at, and again with a telescope rather than a microscope, I think we're in for a troubled future as a country.
But in the meantime, in the short term, presumably there's still opportunity there as a shareholder.
Well, there's plenty of growth, and we've heard that in the article.
Now, Roger, last time we spoke, we talked about free trade agreements. You got quite excited. I felt I cut you off a little bit, so I'm going to come back to that if that's all right. Which is, the Chinese free trade agreement. Part of it was possibility changes of foreign investment in Australia.
Yes.
Now, it's not clear quite what is going on, and obviously this is all one big negotiation, but what are your concerns there?
So my big concern is we don't add value to our exports. As a result, the value of our imports is much higher than our exports, so we have a current account deficit. Now, Andrew Robb told me that's structural. In other words, that's code for we're not going to do anything about it. And we can see that manufacturing's dying in Australia. We're not adding value to our exports. Because we've got that, we need a capital account surplus. So you hear the government saying that we need foreign investment. Yes, we do, because we can't afford our imports. So what do we do to attract that investment? We have to sell our businesses. We have to sell our farms. We have to sell our land in order to attract that foreign investment. And only last week we heard that China, as part of the FTA negotiations, wants its own labour. They want to import their own labour into the businesses that they own in Australia. That completely cuts us out. So we've sold our businesses. They grow product that they sell to their own country. So there's a closed revenue and business model loop. And we don't even get salaries from being employed by those businesses now if they import their own labour. So what we're doing is we're actually selling our land to allow foreign owners to run their own businesses with their own labour, their own revenues, and we see no benefit from that.
Really interesting, because you have to go back almost, I think it was 2011, it was the late Senator Judith Adams at one of the Senate inquiries who was saying what the Chinese want to do is bring their people, this was in relation to the wheat belt in Western Australia, their people out to farm these lands, grow the grain and ship the grain back again. So this is not a new thing, but at the time I remember people saying, well, that's madness. But it's become more of a possibility now because of the importance of this free trade agreement, I suppose.
The free trade agreement is a red herring. The issue is manufacturing and value adding to our exports in Australia. If we don't do that, we are on the path to serfdom. And this current FTA negotiation is highlighting what the rest of the world wants from Australia.
Roger Montgomery, I'm sure a lot of market economists would disagree with you. Thank you very much for joining us.
Thank you.